Okay, well, thanks a lot. Thanks for having me. This is officially still FOMC blackout, but I am presenting material that I've presented before at the Norges Bank and at Texas Monetary Conference. So we're looking for input on this. This is joint work with Riccardo de Cecio, also at the St. Louis Fed. And it's about monetary policy and income, wealth, and consumption inequality. Obviously, a lot of people are interested in that. Many of it are in this room. And I guess the core question or the core point of this is, you know, a lot of people seem to be saying that it's hard to conduct monetary policy in a way that would benefit everybody in a big economy where there's a lot of heterogeneity. I'm going to basically give you an example economy where you can conduct an optimal monetary policy even when you have tons of heterogeneity. So I want to see what you think about this example economy. We actually had a whole conference on monetary policy and the distribution of income and wealth. You can check that out online. This paper has already been referred to here, Kaplan Violante. A lot of people are talking about that. You know, the thing, we're not going to be as good as they are about data or the papers we saw earlier here that were really good about microdata. We're not, this is all going to be kind of Prescott style, you know, calibration. But they get some reasonable Gini coefficients in their heterogeneous agent New Keynesian model. We're also going to get good Gini coefficients in this model. But we're going to limit the idiosyncratic risk. There'll be a trick there. And basically, the policymaker is going to be able to repair the distortion in the economy, even though there's massive heterogeneity. This economy is going to have a large private credit market, and that's basically all it has, is a big credit market. Household credit became much more popular as an area of study after the crisis. It was considered at the heart of the crisis. We already saw papers today on mortgage-backed securities. This is the asset in here. That's what I want you to think of it as. And there'll be this friction, non-state contingent nominal contracting. That'll be the only friction in the model. In the end, I'm going to come back and argue that, you know, what are the similarities with the sticky price friction? I'm not quite sure, but anyway, we wanted to study this. So the friction is in the credit market, and monetary policy will keep this large credit market functioning properly. So we'll get a complete markets outcome. And we're going to forget about the zero lower bound here, but we have a companion paper which talks about that if you want to check that out. So there's going to be a lot of financial wealth, income, and consumption inequality. It's a very stylized model. I want to emphasize that. And basically, people are going to have uneven income over their life cycle, and the role of the credit market is to even out that uneven, or translate that uneven income profile into a very even consumption profile over the life cycle. So you're going to naturally, in this model, as in a lot of overlapping generations models, you're going to naturally rank these Gini coefficients. So we're going to get that as a natural outcome of the equilibrium. And optimal monetary policy then is going to look like nominal GDP targeting. And I'll give you a special case where it is exactly nominal GDP targeting every day. And then cases where it's kind of approximate nominal GDP targeting. Nominal GDP targeting is also characterized as counter-cyclical price level movements. We're going to get that also here. And this result, this will actually be optimal. And that's going to hold even when there's enough heterogeneity to approximate these Gini coefficients. So the main result is right here. If you want to, you know, take a rest here after this. The main result is nominal GDP targeting is optimal monetary policy for the masses. Go ahead.
Do you mean nominal GDP level targeting or growth? In the sense of inflation targeting versus price level targeting, but for nominal GDP?
No, you're going to make up for, you're going to keep the nominal GDP is going to stay right on the nominal GDP path that's defined by the inflation target and the mean rate of productivity growth in the economy. All right, so what is this environment? Well, it's a life cycle economy, many period overlapping generations. The key variables are privately issued debt, and I put this in italics on purpose here. So a lot of times when you start talking OLG, people think, oh, there's federal debt, there's tax systems, all this kind of stuff. There isn't any here, so there's privately issued debt. That's the only asset. Real interest rates, there's inflation, but I'll get to that in just a moment. So I want to think of this privately issued debt as mortgage-backed securities. So what's going on is that you've got people that are sort of 30 years old, 35 years old in this model. They're writing something on a piece of paper, they're giving it to Larry, and Larry's giving consumption to me. And so that's the nature of the asset in this model, but it's not, so it's a privately issued debt. That's what I want to think about. So call that mortgage-backed securities. Why are they issuing this debt? Why are young people issuing debt? Well, it's because they want to pull consumption forward in the life cycle. So it sounds just like a mortgage. It sounds just like real people want to pull housing services forward in the life cycle. That's why they borrow a lot. There are no government spending, no taxes of any kind. Okay, and a key to this, how this works now, is that, come on in, a key to how this works is these symmetry assumptions. So this is going to be solvable by pencil and paper, even though there's an aggregate shock and even though you've got lots and lots of agents in this economy. So the symmetry assumptions, I'm going to get into more detail on future slides, but it's going to be the symmetry of the life cycle productivity profile. That's going to be critical. Along with log preferences, no discounting, so the beta is equal to 1. You don't need discounting in the OLG model, no population growth. And with all that, we're going to get that the real interest rate is exactly equal to the output growth rate of this economy, even in the stochastic economy. So normally you would have to, with an aggregate shock, you would have to track the asset holding distribution in the economy. But it's so easy here because it's all going to be linear in the real wage. So I like this because you can guess and verify that this is the solution, so that's very helpful. And you can think then of the growth rate of the economy as being the Wickselian natural rate of interest in the economy. And in fact, the optimal monetary policy will be to always push the real interest rate back to the Wickselian natural rate of interest at every period. So that, in that sense, it's going to look a lot like what you might get out of a new Keynesian analysis. So we're going to get a set of easy to understand baseline results for this economy, and that's going to be the, if there is a strength of the paper, that'll be the strength of the paper. So this is a T+1 period DSD life cycle model. And those of you that have heard me talk about this before, I like to set this to 240, T equal to 240. So it's a 241 period model. Why is that? I want it to be a quarterly model. A lot of times when you're talking OLG, people say, okay, long run issues, big picture, that kind of thing. No, I want it to be, a model that we can use for ordinary monetary policy analysis. And so it's going to be standard OLG, but every cohort will come in, they live 241 periods, and they die. And then, a new cohort is born every period. You can set this T to anything. So if you want to do some simple math and stuff, set it equal to 2 and have a 3-period model. But if you want to do something that looks like data, then you can set it to 241. You could even set it to infinity and have a continuous time model. That works too. I've done that as well. And there's just this one asset in the model, the privately issued debt issued by relatively young households to middle-aged households. The middle-aged households are the lenders in this model. They have incentives to lend because they need to save for retirement. We don't have any money demand here, so we're just going to say that the monetary authority controls the price level P directly. We do have money demand in this other version, so you can go check that out if you want that. But for today, it'll just be the monetary authority controls the price level directly. And then you've got this log preferences assumption, no discounting. And I know a lot of you have worked on other things, but none of those things are in this model. So there's no capital here. I actually think we could include capital. You could include population growth, but there's no default here. So everyone repays these one-period loans. That's an interesting issue. That would be very difficult to do. There's flexible prices here on everything. There are no borrowing constraints here, so you can borrow as much as you want anytime in the life cycle.
Why isn't monetary policy neutral?
Non-state contingent nominal contracting. So I'm going to come to the friction here, right here. So these loans are dispersed and repaid in the unit of account. So if you and I want to contract, you're middle-aged and I'm young, all we're going to do is name an amount and a nominal interest rate. That's all we're going to do. What we should be doing is doing things in real terms, and we should be making everything state contingent on the shock in the economy, but we're not doing that. So there are two aspects to this. One is that the non-state contingent aspect means that real resources are misallocated in this economy. The nominal aspect means that the central bank can ride to the rescue and do something about it. Okay, so you kind of need both aspects of this assumption. Please.
You said that there was no default and no borrowing limit. How do the people in period T+1 for repay loans? Like old people who are T+1 years old?
Oh, they're going to be spending down, so they won't be borrowers. They will be net asset holders. And then they get to their last period, they consume everything done.
So they do have borrowing limits? Like they are not allowed to borrow?
No. No, they won't want to. They won't want to. I'll show you.
Well, there's probably a natural borrowing. So that is, the natural borrowing limit would be the amount that they could borrow, that they could only pay back by setting consumption to zero for the rest of their life, something like that. But they probably don't.
This is general equilibrium. They're going to borrow exactly the right amount.
Okay.
So they're not going to want to do anything else.
They could default on the thing. Like if they borrow infinity in the last period and then not repay. Like so either.
Yeah, no. I once went to the National Zoo and they had the monkeys out of the cage, and the monkeys were just hanging out in the trees. And I said to the person, "How do you know? Why don't they run away?" And they said, "They've got everything they need right here." So I think this is what's going to go on. They can get exactly the loan that they need, and they're going to be able to smooth consumption over their life cycle without doing anything else. So you don't have to put any limits on them. They're not going to do crazy things.
So the contracts are one-quarter contracts or?
Yes. Okay. So these are one-period contracts, and in this literature, some of you know Kevin Sheedy's paper or Evan Koenig's paper on this, and we're building off of those guys. It's kind of a big issue, well, especially in Sheedy's paper. Do you have multiple period loans? Carlos Garriga, my colleague in St. Louis, many period contracts, fixed or variable rate loans. This is very simple. This is one period loans. So it's kind of the ultimate in variable rate loans. You're renegotiating every single period. And so it'd be interesting to put fixed rate loans in, but we don't have it. Go ahead.
So that means the consumption smoothing is really coming from like equity extraction, if you want. You can lever up or reduce your leverage, and that's how you smooth it. Because just
you're gonna have a negative net asset position early in the life cycle and a positive net asset position late in the life cycle, as it is in the day.
What if I just rent an apartment and pay essentially the amount of rent that I?
Don't take me too literally. This is a very abstract model. There's just going to be net assets, and all this is doing is pushing consumption around over the life cycle. There's no actual housing market here. I'm just motivating what's going on by a housing market. There's a technology and it's linear, and a key aspect of this is that this L is aggregate labor input. That's actually going to turn out to be constant. I'll show you how that works. And then this Q is going to, which is the level of technology, will grow over time at this rate. Lambda, I got into this t+1 notation. This is a growth rate between time t and t+1, and this is a gross figure, so this is a number a little bit bigger than 1. And so this technology is going to be growing over time. So it's a growing economy. You have to keep that in your head because everything's based on the growth rate of the economy, and it's stochastic. So the wage then, the real wage will then also grow at this same stochastic rate here. And we're going to use this particular stochastic process here. It's just an AR1 process, and it has some serial correlation here, a scaling parameter. I put some bounds on it so that we don't hit the zero bound. But really, you can do a lot with this. You could do a lot of different, there's no real restrictions on the stochastic process. Oh, and then there'll be a mean rate of growth of the economy, this lambda bar. Okay, and timing, of course, is critical in how this world works. So nature moves first and chooses the rate of productivity growth. The policymaker gets to observe that and moves second and gets to choose PT, the price level for that particular date. And then households go ahead and consume and save. And this is going to be critical to how the model works. Now this contracting, we're going to fix the nominal interest rate one period in advance. And if you look at the literature on how you do this, you look at the Euler equation. We've got log preferences. Everything's very simple. So you get this vaguely familiar equation here. This is inverse. You should interpret this as nominal GDP. So it's really expected nominal GDP is going to be the rate at which they'll contract. And wait a minute now, we've got all these agents, massive heterogeneity here, but they're all going to have exactly the same expectation. So this is the guy born at time t in real time t, and this is the guy born at time t plus 1. So this is the ratio of marginal utilities for that guy. But if you looked at the guy that was born at time t minus 1, their expectation would be the same, and their expected consumption growth rate would be the same in the equilibrium that we're studying, in the optimal equilibrium that we're studying. So I only have to look at one of these instead of a massive amount of these.
How is that possible? There's I thought that there should be a covariance term here that has to do with the expected price tomorrow. So depending on when you were born, I don't know. I didn't understand why these holds for every single cohort. It's just continuing on a policy, right?
So we've got log preferences, we've got other simplifying assumptions. We know that the interest rate, the real interest rate is the output growth rate.
So
All these things.
Something here that you're going to find out a policy that makes these
Yeah.
Euler equation
Oh.
holds for every single
So-
iteration.
They decide how much to work and consume and save. But once the policymaker moves, this is actually a deterministic decision at that point. Because what you've done, what the policy is doing is wiping out all the uncertainty out into the infinite future. And so that's part of what simplifies it. That's why we can do it with pencil and paper. So here's what the policymaker does. This is the countercyclical price rules. So the guys have contracted in the previous period on the nominal interest rate, but this is the realized, I got into this, putting this little R here for the realization of the lambda process. The actual growth rate, productivity growth rate turned out to be this, and what you have to do is adjust the previous price level by this ratio in order to get to this, okay? And then this is going to be optimal policy. Then the way you solve this is you substitute that back into the budget constraints of the agents. That's going to kill off all the uncertainty that they face off into the infinite future. And we're going to be able to solve, from that point, we're going to be able to solve deterministically everybody's problem in the whole economy. So it's still a stochastic economy. You're going to get a new draw next time, but every time you solve the household problem, it looks like a deterministic problem. So that's the trick here. So this is very similar to Sheedy and Koenig, who also said there should be countercyclical price level.
I just still don't get it. So what happened with the expectation that you showed in the previous slides?
That's right here.
Oh, okay.
That's right there. That's the definition of that, yeah. Given this policy rule, households will consume equal amounts of available production scaled by their productivity. That's equity share contracting. So equity share contracting is known to be optimal when preferences are homothetic. So that's an argument about why this is the best policy in this economy. So, you know, we all produce different amounts, but we all consume equal shares. All right, let's look at this life cycle productivity profiles. Here's where the massive heterogeneity is going to come in. When you come into this economy at like age 20, you're going to be handed a productivity profile. And there's basically going to be a baseline profile, but you might be handed a scaled up or a scaled down version of that baseline profile. So there's some sort of idiosyncratic risk, but you experience this idiosyncratic risk all at the beginning of the life cycle. We think of this as some kind of proxy for all the schooling that you went through up until age 20 and parenting and so on. And so we're going to have this baseline productivity endowment, which I'm going to show you in just a second. And then we're going to have a scaling factor X, and it's drawn from this uniform distribution. And we can choose this to be as big or as little as we want. And we like to cite Huggett, Ventura, and Yaron. They said that the initial level of human capital matters more than the shocks that people often have in these models. So we're going to take that to the extreme, get rid of the shocks altogether, but put the heterogeneity at the beginning. And the baseline profile, I wouldn't take this too seriously, but we're going to use this as a baseline profile. But you could use kind of any baseline profile that would meet the symmetry assumptions. So symmetry means anything that begins sort of at a low value, rises to a peak value exactly in the middle of life, and then goes back down the same way that it came up. That's what symmetry is. And you get this profile, that's your productivity profile, that's your productivity units. You can sell those units on a market which is competitive at that real wage. You're also going to make a labor-leisure choice. And that's how much income you're going to get in a particular period. So here's our baseline profile. Again, I think the only point to make here is low, high, low, and symmetric. You could use lots of different functions here. We're going to use this particular one. I think something that's impressive about this is that without monkeying around very much with this, we're still going to get the Gini coefficients. So it looks like it doesn't matter too much. We didn't have to search very hard to get this. And then we're going to set this Xi term to 6.5. And that's what's going to give you this massive differences in productivity. So the mean guy is here, but there's a low guy down here. Looks like he's almost flat, but he's actually just got the same slopes as everybody else. And here's a rich guy up here, a doctor or a dentist or something like that. Okay, so you've got lots of different levels of productivity, but they're all scaled versions of one another. Defined stationary equilibria, maybe I'll skip that. Theorem says general equilibrium gross real interest rate is equal to this stochastic rate of productivity growth in the economy at every single date forever. The monetary authority is using their policy rule all the time. Time extends from the infinite past to the infinite future. Any two households that have the same productivity profile, consumption will be equalized at a date. That's the equity share feature, but I'll show you some pictures here in just a minute. Okay, now on labor-leisure, what happens is that we've got log-log preferences, so everyone works the same amount over the life cycle. So this is the 0 hours to the full endowment of hours. This is the leisure profile. This is the hours worked profile. This is in the US data. 19% of available time is devoted to work, so we calibrated to that. But whether you're a rich guy or a poor guy, you make the same choice to work the same number of hours over the life cycle. So basically, people work a lot more in middle age during peak earning years, and they don't do much early in the life cycle or late in the life cycle. We prevented retirement here because we didn't want to do corner solutions, so this is a way to do that. Okay, so now people are going to earn income based on what their what their hours worked are, what their labor productivity profile is, and what the wage is. And you're going to get a labor income mass that looks like this. Here's the poor guys. Oh, and to read these charts could be thought of as what happens to me over my life cycle, but they're probably better interpreted as the cross-section of the economy at a point in time. So this is the guy that's just coming into the economy. This is the guy that's at the very end of the life cycle. This is the very middle of the life cycle. We've made everything symmetric around this. And then because of the various productivity profiles, you're going to get this entire mass of income. Some people earning, easily 7 times the income of a guy that's right here, or many more times of this guy down here. Very little income earned in the beginning or the end of the life cycle. Here's the consumption then. So the whole trick here is that the life cycle income is translated into perfectly even consumption for any two agents that have the same productivity profile. So here's the average productivity profile in the economy. Here's all the income in the economy. Here's the average consumption profile in the economy for any two agents that are anywhere on this blue line. They're going to all consume this amount. If you took the very richest guy up here, they would all consume this amount no matter where they were in the life cycle. And the very poorest guy here would consume this amount. So the consumption is a box in this picture, while the income is a hump-shaped mass. This is my favorite picture. So wake up for this one. This is the asset holding cross-section in this economy. Here's the guy just coming into the economy. Here's the guy at the end of the life cycle. Here's the guy in the middle of the life cycle. And this is net asset holding. This is for the guy that has the median productivity endowment, or the average productivity endowment. This is the very rich guy. The very rich guy will borrow a lot because this guy needs to pull a lot of consumption forward. This guy will also save a lot for retirement. This is approximately age 65. This is approximately age 35. You'll also have agents that are poor and, at least on this scale, will appear like they are not saving, or not borrowing as much and not saving as much, but that's because they're poorer relative to the other guys. So the wealth Gini, the financial wealth Gini then would just be looking at this to calculate a Gini coefficient out of this. That's how it's normally done. Here are some different ideas about what income could be in this economy. You could have labor income, which we showed you already. You could have labor income plus non-negative capital income. You could have non-negative part of total income. Here's some pictures. I'm going to skip over this. Let's get to the inequality part. In the data, the inequality in the US for consumption, it would be maybe 32. For income, we took CBO, it would be 51. Gini coefficient, and for financial wealth, this is financial wealth now, 80 in the US. In the model, and we're defining financial wealth as a non-negative part of net assets, and we'll use this calibration here, you're going to get these Gini coefficients here. So consumption Gini, very close to the US data. Income Gini, very close to the US data. Financial wealth Gini, a little bit short of the US data. But you have all this heterogeneity. You've got enough heterogeneity that you can imagine this taking this model more seriously to the data, but you still got optimal monetary policy as part of this equilibrium. And then here's how, this is our dispersion parameter in assigning those productivity profiles. We used a value of 6.5, which is about here. This gave us the consumption Gini here, 32, income Gini, 51, financial wealth Gini, 72. But you could use other dispersion parameters, and here's how they would change. If there was no dispersion at all, the consumption Gini would go all the way to 0. But it doesn't really help you to go even higher. There is a limit there to how far you can go as far as the Gini coefficients. So the ordering's preserved, and we're not really choosing a special value here. You could be pretty close with other values. Oh, policy. So I think I have.
Just over 10 minutes, 12 minutes, 13 minutes.
Oh, I can
Leisure.
really get into this one. All right, good. All right, so one issue is, gee, Jim, you've got this price level rule for policy that, policymakers like to talk in terms of interest rates. So how can we get back to interest rates and talk about interest rates? Well, the policy rule is to have countercyclical price level movements, but contracts are made understanding policy, policies made understanding contracts. That's the nature of the general equilibrium. So if we find a fixed point of this process, we're going to be able to characterize everything in terms of a nominal interest rate and think of policy in the nominal interest rate terms instead. So that's what we're going to do. So to get to this, remember that the contract rate, when you and I are contracting, we're basically going to set a nominal interest rate that is our expected rate of nominal GDP growth.
Can I ask a question?
Yeah,
about
sure.
that?
Yeah.
In what sense that interest rate is set by the contracting parties and not taken as given? I mean, because when we write down an Euler equation in our models, we assume that households, individuals take the interest rate as given, and then that determines, and also the price level as given, and that determines their path of consumption. But here, you seem to turn it around as if that equation that you showed us that looked very much like an Euler equation is one that is used to set the interest rate. So could you clarify this?
Well,
Or am I missing?
no, they're gonna have to contract on a nominal interest rate. The nominal interest rate is in place from today till tomorrow, but you and I have to decide
But they don't.
what nominal interest rate are we going to agree to.
We don't take it as given, as is we usually assume in our models.
No, you're setting it. You're setting it. Yeah.
Is it bargaining? Is it bargaining?
Well, it's all going to be general equilibrium, so it's going to be hard to tell in the end whether it's really the policymaker that is, because everything gets ratified after the fact. So, but that's how you have to think of it. Two people are meeting. They have to decide on a nominal interest rate. What nominal interest rate are they going to decide on? In this simple model, it turns out it's just the expected rate of nominal GDP growth, and everybody would have the same expectation, so there wouldn't be any difficulty in agreeing on that particular rate.
So could you think of it as a bargaining thing, like with norms? So that is to say, this is the norm. You and I come together, we're interested in doing a deal. The norm is proposed, and we accept it. So that may be the way to think.
We could put more structure around it, but I guess to us it didn't, there wasn't anything else that they could do. If they're going to contract a period ahead, this would be the logical thing for them to do in this situation. But, you got to pay off that nominal contract because it is a contract and there's no defaulting or anything like that. So, if we accept that the contract rate is the expected rate of nominal GDP growth and that the Wickselian natural real rate is just lambda, because we've already said that output growth rate is the real interest rate in the economy, the policy is to ratify the nominal contract ex post. And I'll show you some pictures of this. So that's the nature of what the policy always does. So it is actually going to pay off in nominal terms. But what that will do is make the real rate equal to this Wickselian natural real rate. So that's the sense in which I said at the beginning. It's a lot like New Keynesian model, a simple New Keynesian model where the friction is kind of pushing you away from the Wickselian rate, but the policymaker is always putting you right back on the Wickselian natural rate. Why is it nominal GDP targeting? If rho was 0, so there was no serial correlation in the shock at all, so you just have IID shocks, then the expected rate of nominal GDP growth would always be the same. No matter what happened today, I would still expect tomorrow the same rate of nominal GDP growth, and the economy would never deviate from the nominal GDP path because the policymaker would always be making sure that the contract was ratified. And so this would actually be perfect nominal GDP targeting. You'd actually be right on the nominal GDP path every single period. If there's some serial correlation, then when there's a shock, the shock is going to persist for a while, and because of that, the expectation will now be lower or higher than the nominal GDP path for a little while, but you'll go back to the nominal GDP path. And so it's still nominal GDP targeting up to however much serial correlation there is in the fundamental shock in the economy. And so now you'd get a nice smooth path that would go up and down around the nominal GDP path that would exist in the case of rho equals 0. And nominal and real rates fall in recession. So to me, this makes this is reassuring. Let's say so. We have we have one picture here. Let me just spend a little bit of time on this. So this is a calibrated, just a super simple calibrated case to show you what's going on. So the technology would be growing at a 2% rate, and the inflation target, I think, is 3% here. Okay, so you start at a 5% nominal interest rate up here. And then the price level is arbitrarily set to 1 at the beginning of this. And so the shock hits, it's a recessionary shock, and output falls compared to where it would otherwise be. And the classic part of this is that it is countercyclical price level movements. So the policymaker reacts in the period of the shock, the policymaker reacts by increasing the price level in such a way that the nominal interest rate stays right where it was. So the contract nominal interest rate is ratified ex post because the policymaker raises the price level. So that's the part about nominal interest rate, nominal GDP targeting. But after that, in the next period, the expectation of the growth rate of the economy is going to have fallen because it's a serially correlated shock. So the nominal interest rate is going to fall. And so the policymaker is going to ratify that nominal interest rate with a lower rate of inflation. The shock is going to gradually dissipate and come back. The price level had a one-time movement up, but then goes back to a slower pace of increase. Inflation goes back to target slowly from below. So to me, there's a recession. Nominal interest rates fall. Real interest rates fall. Inflation falls and then comes back to target, except for this. This is the hallmark of this that's different from what you would otherwise see.
There's a permanent effect on the price level. permanent effect on output?
No.
There's a permanent effect on output, in real output.
Right, because the technology was weaker for a while. Yeah,
So
that's right.
If the nominal GDP goes back to where it was,
Right,
then the price level must have changed.
Right.
So that's what makes it.
that's
different
right,
from
because there
price
was
level.
this, yeah. So this is as far as we got with the interest rate thing, so if you care about this issue. All right,
So I guess if you think about the exercise, not as a recession, but as a boom.
yeah,
So
it'd be exactly reversed, yeah.
Yeah, so you might have a period in which you have deflation, right? So you have to engineer.
Except that we put limits on the shock so that we wouldn't hit the zero
Yeah,
bound.
just thinking about, yeah, exactly.
Yeah.
You don't need to have a zero bound to have a period in which you need to engineer somehow, a deflation. That's kind of like, the usual issue with the nominal comparing, which you have, this counter-cyclicality at the price level basically force you to think about creating deflations.
Because it would go down here, yeah.
Yeah.
That's what it says, yeah. Again, we have the earlier paper which talks about if you hit the zero bound, what you need to do.
So you gotta need to increase that, and the
Yeah.
more you increase the rate so much, so you
Yeah.
make inflation goals to just satisfy that the price level is gonna go back to given the exogenity of the technology curve.
Right.
Jim,
Yes,
I wonder if you could maybe just repeat a couple of things.
okay.
So, everybody when they're born, it draws kind of lifetime predictive.
Yep,
And then is it every period they also experience something up, so that's idiosyncratic, but it's a lifetime thing.
right.
Is there something they experience every period idiosyncratically?
Nope.
'Cause I'm just wondering what the problem is here that you're solving. Their productivity is gonna move.
Here's one
this way
profile.
over- yeah,
Here's one
they need to
profile.
smooth their consumption over.
And then
this.
here's all the profiles, all parallel to one another.
So the problem is that I draw this productivity thing, but I'm gonna naturally be more productive, and then less.
Everybody has a picture that looks like that
Consumption
individually.
smooth is where we're at.
Absolutely, yeah.
So, and then you're gonna help as a.
Not only does my productivity differ, but I also work a lot more in the middle of life. So my income it really peaks a lot.
So it's lifetime consumption smoothing, there's no business, there's nothing about business cycle smoothing that.
Here's the income, yeah.
That I'm trying to do.
There's no business cycle smoothing.
I mean, there's no smoothing of I see the consumption going invariant to that.
Oh, there's an aggregate shock, and if the policymaker didn't do anything, you'd have incomplete markets, and I'd have a less good allocation of resources than the one I'm showing you. But that one I can't solve with pencil and paper. I have to go to value functions.
So consumption is invariant to the aggregate shock. Is that right? No. When I
Okay,
had a-
okay, this is a good point now. Okay, so this picture shows you a cross-section at a point in time.
Right.
And now you say, well, next period, the wage is going to be something different. So what's going to happen in this picture? I used to have all these slides that did this. I think you might have seen them. So what's going to happen is the wage will go up, let's say 2% or something. This whole thing, this blue thing, this is all going to shift up, but it's all linear. It's all linear in the wage. So this thing shifts up. This consumption line will shift up. This whole box will shift up. And in addition, you might be wondering what goes on here. There'll be somewhat more borrowing. This will still cross right here. And then there'll be somewhat more lending and saving. Because this thing is the asset distribution that you have to keep track of to solve a heterogeneous agent model with an aggregate shock, but it's linear in the real wage. So all you have to do is kind of multiply this line by W, and you get all the movements that you need to know to solve this model. And Why are they borrowing over here? It's all about smoothing consumption. Why are they saving over there? It's all about smoothing consumption. So is there a business cycle? Sure, there's productivity shocks that are serial correlated and going up and down, yeah.
The consumption is moving along, I mean, consumption has to equal output, I guess, right?
Yeah,
So it's moving along with Y.
yes. We didn't put a consumption picture in, but please.
Is a related question. So here, the monetary authority, by choosing the price level, makes the debt state contingent.
Yes.
Is aggregation. And if I understand your mechanism, it affects all households equivalent in a symmetric way.
Yep.
Is there a chance in this model that monetary policy could affect households differentially? Like, there will be winners and losers from this type of policies of, making that state contingent.
Okay, so every period the agents are making crappy contracts with one another. So ex post, after the shock, some people would like to keep the contract because they would get paid off more than they're going to get paid off under this policy. So you have to, when you think about this being optimal, you have to think, before I know what the shock is, what do I want the policymaker to do? And then they would all want the policymaker to do this policy, because they wouldn't be sure if they're going to get, they're going to be on the winning side or the losing side of the bet on that particular shock. So I don't know if that's helpful. So a lot of times when people think about nominal contracting, they're thinking about, the reallocation kind of thing. And I thought a lot about this, and they think about, well, and I get a lot of questions as a policymaker, aren't you helping, rich people because you're making stock prices go up? Or aren't you helping, maybe you're helping poor people by keeping interest rates low, and the poor people are the borrower people over here. So you're helping these people, and then I decided this isn't the way to think about this. You got to think about this as what is the optimal balance between the borrowing and lending in the economy, and what's the right interest rate in the economy. That's what you want the policymaker to do. And sure, of course you're reallocating, because you're trying to reallocate income over the life cycle and get everybody's consumption to be as smooth as it can be. And that's exactly what you'd be doing with this policy, because you're getting this perfectly flat consumption. Even though I earn all these different income levels at different points in my life cycle, I consume this amount at every point in my life cycle. And this is true for everybody, even the scaled up versions and scaled down versions.
Concern is confusing me.
Yes?
So we look at the cross-section, I see flat, I understand.
We're splitting up the production that's available today.
Yeah.
So Spain produces a bunch of GDP.
Yeah.
We all get an
Yeah.
equal quantity of it, scaled by our life cycle
When we
productivity.
look forward in my life profile, then we're like.
Then it's going to go up. Your own profile is going to go up over time because the technology is improving over time.
Okay.
But every day you're going to split with everyone else who's alive at that date. You're going to split equally.
Now, do we get the best results if we have real debt? If we just had one period real debt, would that be fine?
If you had one period real debt and you did not make it not state contingent, I guess?
Well, I'm not going to make it state. Yeah, no, I'll make it not state.
Okay. If you had that model,
That's not
then the policymaker wouldn't be able to do anything about it, and you'd just have to suffer with incomplete markets.
Okay, but no, sorry, I just want to. So let me just ask this. So with one period debt that's not state contingent, that's real,
Mm-hmm.
that's not very good here. You want state contingent real. You want
Yeah.
state contingent real. And the policymaker is actually delivering that
Yes,
with the price level.
yes. Which is really Sheedy and Koenig's insight on this, I think. And there was earlier work, but I think those are the two that really
Well,
brought
so
that out.
can you do it in slow motion? Like suppose we're going through a recession.
Okay,
We do a recession.
we do a recession,
Now.
so that means productivity growth is slower than it otherwise would be, yeah.
Say you borrowed from me.
Yeah,
And now I'm expecting you to pay me back, and it's a recession.
okay,
Now, in terms of the efficient state contingent debt, should you be paying me more back in the recession or less back in the recession? What should that be? What is the best state contingent debt look like?
The state contingent
Yeah,
contract
we're going down.
would say, I'll pay you back at lambda.
Oh, so you pay. And
I'll
then
pay you
there's
back
the-
at this real rate of interest, and then we're both at the mercy of
So
whatever.
then when lambda goes down, you're gonna give me less goods.
Yeah,
That's the way.
yeah.
Cause I don't like that. Yeah, I just went down. Now you're making me even lower.
Yes, but the timing protocol is critical. So the shock is observed, the policymaker gets to observe that shock, set the price level,
Yeah. Yeah.
knowing that that's going to happen through my whole life. Now I know that I've actually got state contingent real contracting going on in the economy, and therefore I'm going to get the best allocation of resources I can get. Okay. So we did have a point here. Let's see if I can get to it. Blah, 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 blah. Okay, so we're saying U.S. inequality is partly due to life cycle effects and partly due to these heterogeneous scaled up and down profiles. I think it's pretty impressive that you can get most of the Gini coefficients with kind of this back of the envelope thing. We cited Huggett, Ventura, and Yaron on that. Everyone faces a consumption smoothing problem over their life cycle. So whether you're a rich person or a poor person, you've got the same problem. And so monetary policy can do a good thing for every single person in the economy. You might say, I don't like these pictures where you've got very rich people and very poor people. That's fine, but that would be a job for fiscal policy if they want to reallocate between different people in this economy. The monetary policy guys, the technocratic guys, can do something good for everybody in the whole economy. So that's kind of the punchline of this.
Okay.
All right.